This quick 11-minute video is actually a review of one of my xBrat apprentices who is actually killing it this year, going through his homework piece by piece and understanding how he is learning and applying those rules. Check it out. Hello, this is Paul Bradby, and this is a slightly different video to what I normally do because I run an apprenticeship for a select number of people during the year. It's not a large number of people, but this is one of their homeworks. So we're currently in the range breakout phase. So there's 4 strategies with the range breakout, and this week's strategy was straddles and data reversals. And each apprentice has chosen one instrument to go through the whole 40 weeks. And this particular apprentice has chosen copper. So I want to go through his homework, his presentation, because I think this is a really great example of how to use the range breakout for straddles and data reversals. And it's not from me, it's from him. So over 6 weeks, he found 8 data reversals and 5 straddle trades. We're not trying to find lots and lots of trades per day. We're trying to find the ones that meet the rules, the high probability trades. He didn't use the gold pit open since that's early in the morning. He wouldn't partake in that because I know he's in California. So let's go through to the slide. So the next thing he did was trying to find the data, the economic data that affects copper the most, and it basically collected some data. So oil data affects copper the most on average basis with a 73 tick move, and then CPI is next with 61 ticks. So he then looked at a conservative profit target between 20 and 25 ticks for data events, because we've got to be conservative and try and capture all of those moves and not be too greedy. So again, you can see from the table down here, he was looking at CPI, all data, jobless claims, PPI, jolts, FOMC, durable goods, all that sort of thing. And he was looking at those average moves when they happened. We can see with the oil data, jobless claims, there was a lot of moves. And then, working out that average move. So again, getting into understanding the behavior of the instrument that you are married to, because at the end of the day, you really need to understand how it reacts to lots of different things, and economic data is one of the big things. So let's go through some of the trades. So he's on quite a few slides here, but we're going to go through them because I think it's very important. So March 1st, ISM data reversal, move to break even after 10 ticks, trail to area of consolidation, and take profit using the manager. We see the copper. We got the copper open here, but more importantly, when we get the ISM data, we start to come down, then it reverses, comes back out of that opening range, and we get a really nice move up there. So yeah, exactly what it says on the tin, and that's a good trade. March 6th, straddle trade now. So when we look at the straddle trades, we look for a neutral bias on that range breakout, and that's what it is in this point here. 8:15 data, ADP employment. We can see up here it moves down, it bounces off the previous day's opening range, then we get the copper opening range here. We got the neutral bias, which allows us then to use the straddle strategy. He's going to move to break even after 10 ticks, trail stop with lots of fresh air up to the next support and resistance zone up there, and he took profit on the doji, on this doji at this point here. So great move. Textbook move for a straddle type trade. March 7th, next day here. So we've got a data reversal. We got jobless claims that comes out. We get this initial move into this big resistance zone at this point, and then we get that copper opening range, and then we get the move down. So again, understanding what not to trade on the straddle there. Do not take the long in resistance, okay? So entry short only is what he's looking for in that reversal. Move target to break even, take profit at 25 ticks with support below here. So again, he's looking at that average move. He's done his homework, understands the behavior and the average move after jobless claims, and takes the profit. March 12th, straddle trade, long only with HG on the support. So it's right, this opening range is right on the support here. So he's got to understand that the long has the fresh air, not a lot, but more than the short. So he's only going to go long only, take profit at 20 ticks due to close proximity of that resistance zone. So perfect trade. March 15th, data reversal, no trade due to so much risk, because the opening range, the amount of ticks on that opening range is a very, very wide range here. Then you've got the previous day's range, so it's a lot of ticks, a lot of risk, and the right choice here is not to take that trade. So March 18th, straddle trade, do not take due to proximity of support. Again, it did go through, but we're not looking for the if and oh, it did do it, so it'll do it again. We're actually following the rules. There's the opening range is yellow, so we're looking for a straddle trade here. Would only look for the long. It didn't go long. It actually went short, but you're not going to go short into support, so we followed the rules. March 19th, straddle trade, look for short only, move to stop to break even, then trail stop using the manager. So it's a really good move, this one. We're in previous day's opening range to the upside, so it's only looking for the short, and you can see on the buyer's depth heat map here lots of red. So the short was good. It came back to test that range and then came down and kept going. March 20th, data reversal here. Move to break even after 10 ticks, trail stop using manager, move stop to pivot, this pivot here, and then take profit at resistance. So it was a simple trade, more bias to the upside there. Great oil, it was a great trade, and we can see that oil data really affecting copper there. So understanding the behavior of copper, and this is what the apprenticeship's all about. We learn lots of different strategies for different market conditions that work at different times of the day, that allows you to trade that one instrument consistently. So March the 21st now, data reversal, with jobless claims here, longs only with support below. We've got lots of support here from the xBrat Guardian zones, the automated support and resistance zones here. So we're only looking for the long breakout of this copper. You see the bias for the copper at that point is red, so it's bearish. So we're looking for that data to come out and looking for that reversal. And it's exactly what it did, and he'll trail that with the manager. So March the 27th, straddle trade with continuation on oil data. So this was a big trade. We had the long only with support below. So lots of support here, confluence of 30, 15, 60 minute time frames here, all in this really multicolored support. So we're not going to go short here, only looking for the long. It pushes up through this opening range here, and we go long. Move stop close to the 1010 bar. And then we get the 1030 oil data and close out at the resistance, because it continued with that oil data in the main bias of the direction. The directional flow was strong going in there. Oil data just actually increased that, took profit into resistance there. So the next one, March 28th. So again, the homework is very thorough. We do the pre-recorded education, then we do a live session, then they go away and do the homework that I set. And this is a really good example of how to get that homework done. So March 28th, data reversal, short only with resistance above. Again, following the rules. It's not rocket science here. We've got jobless claims, which takes us into that resistance. The resistance is too much. We get the copper and it comes back down, and then we get a nice move. Take profit 25 ticks, as average move for this data is 28 ticks. Doing your homework, understanding when to take that profit. When do those data reversals run out of juice on average? And then only go short with resistance above 25 tick target. It's the same trade, but you can see that resistance really strong out here. So April the 4th, data reversal, again natural gas this time, really good. We've got jobless claims and natural gas. With the jobless claims, we've not got any fresh air. It doesn't take that long because we're going into that resistance. Natural gas then pushes us down. We break out through the bottom of that range, and a really good trade. So the entry is 2 ticks below the copper, the range, opening range here, which is perfect. We're coming up to test resistance. We get natural gas and it pushes it down, and we get a really great move there and trail with the manager. April the 11th, the last slide now. Data reversal, no fresh air, no trade. Simple. Not there's no just trying it or whatever. It's the rules. We get this copper opening range here. There's no fresh air to the upside. We're boxed in support and resistance here, so we just don't take the trade on that day. So I just want to give you an overview, and actually it's a good learning tool for everybody using our range breakout with those 4 strategies. These are just 2 of them, the straddle and the data reversals. So very, very powerful tool, but I wanted to use this apprentice homework because it's some really great examples, and it's also an example of trying to understand very, very intimately the one instrument that you should be trading. You shouldn't be trading 4 or 5 instruments. It's impossible to understand that behavior on economic data, on news, on the correlations, and lots of other things that we cover in the apprenticeship. It's easier just to look at 6 different strategies for different market conditions, different times of the day, that all work on the same instrument. So you're concentrating your efforts on that same instrument. I'm actually going to put the link down below to check out a little bit more about the apprenticeship, but also about our range breakout trading indicator.